Let's get straight to the quote of this morning. We've been jokingly calling this rally the Ed Sheeran or Dave Matthews rally. Essentially, it is a rally that nobody likes, and yet it continues to go up. The author of that quote, I'm pleased to say, is with us now. Amy Wu Silverman, RBC Capital Markets equity derivative strategist. Amy, let's start right there. Any reason for that to change anytime soon?
So look, guys, so far, no. I was watching the drawdown, the past week with great interest because the option sentiment has been so glum through year end. And, once usually you get kind of a breather, it kind of comes off. And the reality is it hasn't. So, we remain glum. We remain with demand for downside protection. And even despite the move down, that has kind of stayed solid, which just tells you that sentiment is still kind of saying this is unloved and they're waiting for even further of a move.
Amy, the week ends, the week begins, and we have to focus on acuity here, away from the lyrics of Ed Sheeran and Dave Matthews. You've created a firestorm out in the street with your vicious, mean-spirited note. Give us the acuity right now of why you can own equities.
Yeah, look, I think part of it is because the market is well hedged. We are very well positioned to the downside. I'll give you guys one stat that I think really puts this into context. If you just sold one of these 10% out of the money put options on the S&P in October, right now you can buy the equivalent 60 times the upside. Now, just to provide some history on that metric, back in July, that was at 15 times. So what that's telling you is the market is ready for the market going down. And oftentimes when that happens, the reverse is not true, right? The market is not ready for the market going up. And so, that brings you to a potential path if something good does happen of people having to scramble to get that leverage on the upside.
All I can say, Amy, is I'm sure you got a lot of pushback on the Dave Matthews point, especially based on some of the people who read your notes. A lot of people like Dave Matthews, and we could discuss that in detail.
I learned that the hard way.
Yeah, exactly. Got a lot of hate mail. There is a question about how people are looking at inflation, how people are looking at margin pressures. And one thing that you said in your note that I thought was fascinating is the options market is not pricing in concern at all over a 6-month period or 12-month period for inflation in the consumer staples. However, not really the case in industrials. Can you explain?
Yeah, I think it's important because we kind of talk about inflation in this broad umbrella. And the reality is, obviously, different sectors are going to be impacted differently. When you look at consumer staples on a 2-month period, when you look at the names in it, like a Kroger, for example, where, it was down 9% last week, you're seeing it short term. And yet that disappears over a 6-month period and a 12-month period when you look at those relative implied volatilities. Completely the opposite true is industrials. Now, as I mentioned in my notes, some of this is tax related, but what this tells me is, look, if you believe that the cost pressures do remain in consumer staples over the longer term, that options market pricing has not put that there yet. So that is an opportunity to own those puts within that sector specifically. I think that's how you have to play inflation concerns right now.
How much is this the way that people are looking at the market rather than go long a particular sector? They're looking at how margin pressures are being priced in specific sectors and trying to get ahead of things that way.
Yeah, I think, look, it's going to go sector by sector, Lisa. It's also going to go stock by stock. So, we're really focused on where we see that change in option sentiment. And stock by stock, Kroger, for example, that the normalized skew in that name is at a 2-year high. So essentially the demand for downside protection. Again, this is even after it's gone down 9%. That's what I think is key for people to remember. It's, after you've had that move down, oftentimes hedges are removed. This is not what is happening in names where you continue to see that inflation pressure. So people think it will continue to go down.
Okay, so Amy, after this, I'm in love with the shape of this market. That's great. Actually, go out there, folks, and read Ed Sheeran lyrics. It's
Tom, that was beautiful.
John,
little piece of me just died.
Good jokes don't need to be explained, TK.
Well, I didn't say it was a good joke, but Amy, we're in love with the shape of this market. But the reason why the skew is the way it is, Ed Sheeran taught me the Greek letters. The reason that the skew is the way it is fear. How do you know when to step into fear and go long?
Yeah, look, you don't. I wish I did. It's always about timing, right? You don't.
Yeah.
The way I kind of think about it is, what could possibly drive, this market to the upside. What Lisa said earlier about just the childcare point, I feel deeply personally because I have two school-age children. But look, if you get a vaccine earlier than expected for the under 12 crowd, right, the crowd that actually needs childcare infrastructure, that's something that could potentially bring this market up. The same with, a better than expected NFP data point. Again, the timing is always difficult. The point is just that the positioning is really not to the upside at all.
Amy, that's so important. Let's finish there. Do you think that authorization for children could have a similar effect on this market in the same way that we saw things develop in early November last year?
Yeah, look, I'm not a medical expert, but I think that this is one of those things where you just kind of know personally if you're living through it, right? Like if this is something that that you can safely send your children to school, and so you're not, calling a backup sitter at the 11th hour because you still have to go to the office and you can't leave a 7-year-old at home, then sure, of course it helps. That makes it so the stability of the return to work is something that can happen.
Amy, thank you.